Imagine this: nearly 30% of small businesses fail because they run out of cash. It's a startling truth in the world of entrepreneurship, highlighting just how crucial financial management and support are. But here's the good news: securing a loan isn't as daunting as it sounds, provided you know the ropes. In this guide, we'll unlock the secrets to not just applying for a loan, but clinching a deal that's perfect for your business. From drafting a bulletproof business plan in The Groundwork, to navigating the often overlooked nooks of credit scores in Credit Chronicles, we've got you covered. We'll even dive into choosing the right lender in The Lender Lowdown, and show you how to make a compelling case in Persuasion Tactics. But what if traditional loans don't fit your needs? Don't worry, Plan B. We'll explore alternative routes to fund your dream. By the end of this journey, you'll be equipped not only to secure a loan but to choose one that best fits your business strategy and growth plans. Are you ready to turn those daunting bank doors into welcoming gates? Let's get started. Chapter 1: The Groundwork: Mastering Your Business Blueprint. Starting a business is thrilling, but securing a loan? That can be daunting. Before approaching lenders, you need a solid business plan. It's your roadmap to success. Think of it like a resume for your business. Without one, securing a loan could be a lot harder. Here's a kicker. Did you know that businesses with a detailed plan are 16% more likely to succeed? That's not just a number. It's your first step towards getting funded. So, what should a great business plan include? Begin with your business idea, market analysis, and clear financial projections. This isn't just fluff. Lenders scrutinize this to gauge your business's potential. Creating financial projections might sound complex, but it's about outlining your expected income and expenses. Be realistic and conservative in your estimates. Remember, lenders see over-optimism as a red flag. Your business plan should also showcase your understanding of the market. Who are your competitors? What's your edge? Maybe it's a unique product or a new approach to customer service. Highlight whatever sets you apart. And don't forget about your team. A section on your team's background can really bolster your business plan. Experience and expertise in your industry can significantly boost your credibility. Lastly, think of your business plan as a story. What's your vision? Where do you see your company in 5 years? Lenders aren't just investing in ideas, they're investing in visions they believe can succeed. Chapter 2: Credit Chronicles: Boosting Your Borrowing Power. Your credit score is like your financial fingerprint. It shows lenders just how reliable you are with money. But many small business owners overlook this crucial aspect. A low score can not only limit your loan options but also spike up the interest rates. So, how can you boost your credit score? Start by checking your credit report for errors. Surprisingly, 1 in 5 people find mistakes on their report that can affect their scores. Fixing these can give your score a quick boost. Paying down existing debt is another smart move. It lowers your credit utilization ratio, a major factor in credit scoring. Aim to keep it under 30%. This tells lenders you're good at managing debt. Also, consider your payment history. It accounts for 35% of your credit score. Always pay your bills on time, every time. Even a single late payment can hurt your credit score significantly. Building credit isn't just about reducing negatives, it's also about creating a positive borrowing history. If you lack credit history, a small, manageable loan could help build your score. Just make sure you handle it wisely. Remember, improving your credit score is not a quick fix but a vital strategy. Higher scores mean better loan conditions. As Warren Buffett wisely said, risk comes from not knowing what you're doing. In the context of credit, being informed and proactive is your best strategy. Chapter 3: The Lender Lowdown: Shopping for Your Money Match. When you're looking for love, you don't marry the first person you meet. Similarly, when seeking a loan, don't rush into a deal with the first lender you come across. It pays to shop around. There are traditional banks, online lenders, and credit unions, each with their unique advantages. Banks might offer lower interest rates but expect stringent credit requirements. On the other hand, online lenders might be more flexible but could charge higher rates. Credit unions, being non-profit, often provide favorable terms to their members. Choosing the right one could save you a lot of money and stress down the line. It's important to understand each lender's criteria. Some might value credit score above all, while others might focus more on your business's revenue or your plan's robustness. Knowing this can help you tailor your application to match their preferences. But how do you find this information? Start with the lender's website, but also don't hesitate to pick up the phone. Speaking to a loan officer can give you insights that aren't always apparent online. Plus, it shows them you're proactive and serious. A pro tip: ask other business owners about their experiences. They can provide real-world insights and may even tip you off about lenders to avoid. Remember, each application might affect your credit score. To minimize the impact, aim to apply within a short time frame. This is often seen as rate shopping and can be treated as a single inquiry. And finally, read the fine print. Fees, prepayment penalties, and hidden charges can sneak up on you. Make sure you understand all the terms before signing anything. Chapter 4: Persuasion Tactics: Crafting a Compelling Loan Application. Your loan application is more than paperwork, it's a pitch. You're selling your business's potential. Every detail counts, and missing information could be a red flag to lenders. So, double-check your work. Start with clarity and precision. Define your business, explain why you need the loan, and how you plan to use it. Be specific. Saying you need $50,000 for inventory is more convincing than a vague mention of needing funds for growth. Your financial statements are the backbone of your application. They show not just where your business stands, but also where it's heading. Ensure these documents are accurate, up-to-date, and thorough. Sloppy finances can kill your application's chances. Then, emphasize your strengths. Maybe it's your industry experience, a robust customer base, or innovative products. Whatever your strengths, make them shine. This can make a huge difference in how lenders view your risk as a borrower. It's also wise to acknowledge risks but show how you plan to mitigate them. This demonstrates foresight and maturity, qualities lenders admire. A helpful hint: include positive reviews or testimonials from customers. These can be powerful in showcasing your business's impact and reliability. Lastly, always follow up. A quick call or email after submitting your application can keep your business on the lender's radar and shows your enthusiasm and commitment. By meticulously preparing your application and effectively communicating your business's strengths, you stand a better chance of not just securing a loan, but also forging a beneficial relationship with your lender. Chapter 5: Negotiation Know-How: Terms You Can Afford. Negotiating a loan isn't just about accepting whatever is handed to you. It's about securing terms that work for your business. Start by understanding that everything can be negotiated. Interest rates, repayment terms, even some fees. Approach them with a mindset that these are not set in stone. First, arm yourself with knowledge. Research prevailing interest rates and compare offers from multiple lenders. This not only gives you a baseline for what's fair, but also puts you in a stronger position to argue for better rates. Remember, lenders compete for business just like you do. When discussing terms, be clear about what you can realistically afford. Don't stretch your business too thin. If a proposed repayment schedule seems too aggressive, say so. Negotiating a longer term might increase overall interest but lower monthly payments and ease your cash flow. A key strategy is to highlight your strengths. If you have a strong credit score or a solid business track record, use these as leverage. Lenders are more likely to offer favorable terms if they see lower risk. Tell them why your business stands a great chance of success. Also, don't hesitate to ask for better terms than those initially offered. The worst they can say is no, but often, lenders are willing to make some concessions to secure your business. Lastly, never rush to sign. Take your time to review all terms. If something is unclear, ask questions. You might also consider having a financial advisor look over the offer. It's better to be safe than sorry. Chapter 6: Plan B: Alternative Financing Avenues. If traditional loans don't pan out, don't worry. There are plenty of other ways to fund your business. Exploring alternative financing can uncover options you might not have considered but could be perfect for your needs. Crowdfunding is a popular choice for startups. Platforms like Kickstarter allow you to raise funds by pre-selling products or offering perks to backers. It's not just about the money, it's also a great way to build community support and validate your business idea. Another option is angel investors. These are individuals who provide capital for startups, often in exchange for equity ownership. Angel investors not only bring funds but can also offer valuable guidance based on their experience. Grants are another avenue worth exploring. These are particularly appealing because, unlike loans, grants don't need to be repaid. Look for grants offered by government bodies, industry associations, or private foundations. They often target specific types of businesses or those run by entrepreneurs from underrepresented groups. For those with strong sales but struggling with cash flow, invoice financing can be a lifeline. This involves selling your outstanding invoices to a third party at a discount. It's a quick way to get cash, though it comes at a cost. Peer-to-peer lending is also on the rise. It connects borrowers directly with lenders through online platforms, often resulting in more favorable terms and faster funding than traditional banking routes. Each of these options has its own set of benefits and challenges, but they all provide viable alternatives to traditional bank loans. Finding the right fit depends on your specific business needs and financial situation.